Hello friends, this is Priya from Chennai. Today we are going to see the types of approaches in recording the financial transaction. Let's see what are those approaches. Those are accounting equation approach and the traditional approach. First we will see the accounting equation approach. This means that equation according to the some small mathematical, not that much hard, it will be easy to remember. Assets equal to capital plus liabilities. Here assets equal to capital plus liabilities means capital is the owner's equity and the liability is the outsider's equity, or we can say it as a creditors, bills payable, loans, those things will come under the liabilities. Here capital means the person who is investing some money to the business for commencing the business, for starting the business, we can say it as a capital. So he is giving some amount to the business, that we can say it as a capital. Liability means the creditors. The creditors means the person who is supplying the goods and services for the growth of the business, or he is lending some money to the business. We can say him as some money or a stock. We can say him as a creditor. Here capital and the liabilities both comprises of the liabilities. We can say both as a liabilities. So this both should be equal to the, then only in the accounts will be get tallied. So assets equal to liabilities. So I have already said what is a debit and credit. So assets and capital should be always equal. That is when the owner's equity and the assets means when the person is having the current cash, current stock, those things, fixed assets, that comes under the asset. Both should be equal. Okay, let's see what is first this equation, then after that we can see what is assets and the capital. Okay, increase in capital and the increase in liability. The first rule is the increase in capital and the increase in liability. For example, if a person is investing some money to the business, for example cash of rupees 1 lakh, he is investing the cash to the business for starting up the business. He is giving the money to the business. Here cash is coming in, that is cash comes in, so increase in the assets. Here capital is provided by the owner. Here he is giving the money, the owner is giving the money to the business for the purpose of starting the business. So here increase in liability. Why we can say it is an increase in liability means actually the business, already I have said in the previous video, I have said what is the business entity concept. That is, business entity concept means the business is different and the owner is different. So both are separate entity. So here increase in liability means the business is liable to pay the owner the thing which he has invested in the business. So that may be in the way of profit dividends. So the business has to pay the liability. So that is the liability. Liability means owing. The person who is a debt, that is the person who is giving the money to the business, we can say it as a owner. Okay, let's see what is the assets equal to capital. Here always the assets must be equal to the capital. That is debit always should be equal to the credit. Here assets means the fixed assets, the current assets. Let's say what are the stock which you are having in your hand, then furniture, capital, furniture, those things will come under the asset. The capital means the person who is giving the money, that is the capital. So I think this point you would have understood. Let's see the next rule. Next equation is the decrease in liability and the decrease in the asset. Here paying the creditors 10,000. The owner is paying the creditors 10,000 means here he is paying the cash to the creditors, that liability cash to the creditor, that is cash goes out 10,000, the creditors are paid the 10,000. Here cash goes out means here from asset he is giving out the cash, that is from the asset he is giving out the cash, that is cash goes out is from his pocket, not from his pocket he is giving out, from the business he is giving out. So this is cash goes out is 10,000 and the creditors are paid. And so the creditors are getting the amount of rupees 10,000. So the liability of the business decreases. So here from this point it is clear that the cash is also decreasing and the creditors, that is the liability, also decreasing. That is both are decreasing. Both are decreasing means that debit and credit will be equal. For example, here he is paying the creditors 10,000. Here both will be decreasing. That is cash. Assets is the cash. Assets equal to liabilities. So asset also decreasing. Asset is the cash. Cash 10,000 is decreasing. And the liability is the creditors. That thing also decreasing. That thing is decreasing in the sense we are paying out the creditors. That is the liability which we are liable to pay. Which we are liable to pay to the creditors. That is we are liable to pay to them is the 10,000. The both are decreasing. That is liability also decreasing. And the cash from the assets, that is the business cash, that is also decreasing. So both are decreasing. From this point it is clear that the decreasing liability and decreasing assets means when any expense which we are paying out means it is decreasing from the business cash is decreasing. This point is decrease in liability and the decrease in assets. Next one is the decrease in one asset and increase in the another asset. Here in decrease in one asset and the increase in the increase in the one asset. Okay, here bought furniture for 10,000. Here when a person is purchasing the furniture for rupees 50,000, here cash is going out, cash goes out, that is 50,000. Cash is going out and the furniture we are purchasing one asset, that is we are getting some asset from that cash. So here asset comes in, that is plus 50,000. So increases, the asset automatically it increases. So asset increases and the asset same asset is decreases. Why it is decreases means we are paying out for purchasing that furniture. So we can say it as the asset increases and the cash decreases. Here cash goes out and the furniture comes in. Furniture means one asset for us, that is asset for the business. So we can say it as the decrease in one asset and increase in the one asset. Now we are going to see the next one, decrease in one liability and the decrease in the another liability. Here let's take an example. Accepted the bill drawn by the creditor. Here for example, if the creditor is supplying some goods and services, he is for example the creditor is supplying the goods and services worth rupees 10,000 or any amount. He is giving us for a credit. It may be for a month or a 2 months or 3 months. He may fix that period. So for that he will be giving us a bill. That is, you have to pay this amount within the specified period. Within that period we have to pay that amount. So he will be drawing some bill and giving to us. So that bill will be accepted by us. So here accepting the bill drawn by the creditor for rupees 10,000 we are accepting. Here bills payable arises. So we have to pay the bill to the certain party, that is a certain creditor. The creditor means the supplier of the goods. We have to pay the liability. We are owing to pay the liability to the creditor. Here bills payable arises. Increase in the liability means, here bills payable arises means our liability will increases. That is, we have to pay the liability to we have pay the amount to the creditor. Here reduction of creditors means when we are paying the amount to him, that automatically liability will decreases. So here assets equal to liability. Liability means that is bills payable. This one is I will write here, assets equal to bills payable. So bills payable increases, bills payable increases and the creditors will decreases. So we are accepting the bill for the amount which we have to pay to the creditors. So this bills payable will be increasing. That creditors will be which when we are paying out the debt, when we are paying out the amount to him for the creditors, then this creditors amount will be get decreased, will be get reduced from the what we have to pay. So the 10,000 bill drawn by him will be reduced. Both thing will be get cancelled. That is plus 10,000 minus 10,000 will be get cancelled. So nil balance will be there. 0 will be there. I think this point you would have got clear. So assets equal to increase in the liability and the decrease in the liability. Decrease in one liability and decrease in the another liability. Next one, transactions affecting more than the two accounts. Here transactions affecting the more than the two accounts means we have already seen the transactions affecting only the two accounts we have seen. Now we are going to see transactions which are affecting more than the two accounts. Here goods worth rupees 30,000 sold for the 40,000. Here from this point where we are going to see the goods we are selling out for the 40,000. Here goods are going out from the stock. So decrease in the asset. Here cash comes in. Cash comes in means we are selling the goods for the profit of 40,000. So cash comes in means the profit which cash comes in means we are getting the cash. So the increase in asset will occur. Sold at the profit means the amount which we are selling is 40,000. From the 30,000 when we are reducing, then automatically the profit will be 10,000. So the capital will be increasing by a profit of 10,000. Here let's see 30,000. So asset equal to liabilities. So liabilities is 10,000 is the profit. Then cash plus stock. Cash, how much it is? Cash comes in. So cash comes in means 30,000. So 40,000 cash. So minus 40,000 plus 30,000. So the answer will be 10,000. So here 10,000, here 10,000. So both debit and credit are equal. From this we understood that the asset should be equal to the liabilities. From debit and credit should be equal to the, for recording the transaction, both should be equal. So from this point I think it will be clear that the transaction affecting more than the two accounts, one has to be record the transaction like this. Thank you friends. Then we will be seeing the what is the traditional approach. Traditional approach we will be seeing the traditional approach. We will be seeing what are the accounts involved. Okay, if you have any doubts you can contact to my number Priya. I have written here 6380097 Thank you. I have written wrongly as decrease instead of increase. So I will rub it out and write increase in the one asset, increase in the another liability. Okay, decrease in one liability and the increase in the another liability. Here I have clearly written bills payable arises increase in liability and the reduction of creditors decrease. This one is a decrease. I have put as a DEC. DEC means decrease in liability. Thank you friends. Thank you.